Hello, in this video, I'd like to do a brief overview of some of the what's called voluntarily disclosed sources of accounting information that companies now routinely provide. Now, first, I want to have a brief note on the terminology. There are two terms people refer to when they talk about corporate disclosure that we need to use in financial statement analysis that you may hear. One of it is mandatory disclosure. So the term mandatory implies that it's mandated, it's required. Mandated by whom? In this case, by the United States government, by United States Congress, through the securities laws. And the securities laws, broadly speaking, are 1933 SEC Act and 1934 Exchange Act that require corporate disclosure of financial statements and associated footnotes. Also, you would include here something like Sarbanes-Oxley Act. There are some aspects of disclosure that it has, in particular with respect to companies' internal controls, and so on. Anything that relates to from those laws, those laws govern very broad SEC disclosure that kind of elaborate on how balance sheets need to be presented, how income statements need to be presented in the SEC filings, how footnotes need to be presented. So that is referred to as mandatory disclosure. So when we talk about companies Form 10K or 10Q or an 8K, those are examples of mandatory disclosures. Now, even within those broadly mandated forms, 10K, 10Q, companies these days disclose a lot more than the statute requires. They'll provide all kinds of voluntarily disclosed items. For example, earnings guidance, which is the forecast of earnings next quarter or next year, and so on, or various kinds of non-financial disclosure that may end up there. So anything that is not explicitly mandated by the securities laws and through the securities laws by the SEC is referred to as voluntary disclosure. So I wanted in this video to broadly overview some of the key types of voluntary disclosure, in particular earnings announcement disclosure that gets into the company's press release on a quarterly basis, and talk about some of the key terms that come up in the context of earnings announcement disclosure, because kind of the dirty secret of this business is that this voluntarily provided disclosure of earnings information, which is not audited, which is not required. Companies do it on their own because users, in particular analysts and institutional investors, expect it, drive stock price changes much more than the actual disclosure of the 10K, or 10Q for that matter, that comes typically a little bit later. And 10K, of course, comes after the end of the year. So that's why it's very important to understand that. After I talk about that, I want to talk briefly about analyst reports and role of financial analysts in analyzing financial information. And touch on the comment letters and conclude with a little bit about trust and short-termism and stuff like that. So and that's broadly parts 2B and 3 of the first module. So if you go to Facebook earnings information page, every company has something called an investor relation page, and I just picked Facebook because it's everybody knows Facebook, I presume. Companies typically give all of the have this portal that has all the investor related information in one place. Both they'll provide links to both mandatory and voluntary disclosures here, and it will be for every quarter, because again, quarterly earnings information is probably the most important item that the company will disclose. You'll see here there will be also information, any annual meeting of shareholders. There will be all press releases, whether financial or not, investor events, stock information, and corporate governance information. Now let's focus on, for purposes of our class, quarterly earnings information is the most important. So first of all, what do we see here? Let's say, for example, we just finished second quarter of 2019. First, you'll see a link to the webcast, which is the quarterly conference call that companies, at least larger companies, typically conduct for the benefit of analysts and investors, that discusses earnings information. We can listen to this. You can listen to this at your leisure. I'm not going to go through it, but it's basically, company management, including starting with their CEO, CFO, walking through the most recent earnings report with through a presentation, and even they give us here the slides. You can open them up for a minute for that presentation, that you can see that discusses various results, provides data on daily users, monthly active users. Those are important, of course, because users is one of the key drivers of value for Facebook. Revenue that they derive mainly from advertising by the geography, essentially, which theater they operate in Asia, Europe, or Canada, where money comes from, and so on. So, essentially, this is not audited. This is purely company prepared. And yet it's very important, because that is kind of an overview that the management gives of what happened last quarter. And that's discussed in the webcast. They immediately prior to the webcast, they issue the earnings release, which is going to be their essentially kind of condensed quarterly results. Again, not audited. It will have income statement, balance sheet, cash flow statement, brief discussion of that information. As you can see here, they give us condensed income statement. It will give us other financial highlights, which is daily active users, monthly active users, monthly advertising revenue, capital expenditures, and so on. Now, again, nowhere does it say that's what they must disclose. It's that they choose to disclose because they believe that's what their investors need, their analysts want. And then here's an announcement of the conference call, and you can see the link of that conference call on the previous page. So they first release the earnings, and then they give us information about it. They also talk about non-GAAP financial measures, and I'll discuss that at length in the next module. Companies these days routinely provide both GAAP and non-GAAP financial measures on the premise, and this premise has been debated widely over the years, that sometimes GAAP obfuscates or obscures the truthful economic picture of the firm. Now, companies, obviously non-GAAP, are not audited. The companies are allowed to provide non-GAAP financial statements if they also simultaneously provide a reconciliation of non-GAAP to GAAP, and provided non-GAAP is not emphasized at the expense of GAAP financial statements, and it's not misleading. And that comes from SEC's guidance on Regulation G, which is the guidance on non-GAAP financial statements. Right below that, we see the consolidated statements of income, and note that it's unaudited. Right, quarterly information is not audited. In general, it's typically reviewed. In this particular case, auditors didn't touch this at all. The only thing auditors might have done is look this through to make sure there's nothing openly misleading, but it's purely voluntarily provided by the company. Even though it's unaudited, under the securities laws, company's management still bears full responsibility for making sure this is not wrong or misleading information. If it turns out later that anything about here was untrue in a material sense, management will be subject to prosecution both by the SEC and possibly, if it's egregious, by the Justice Department for violations of securities laws. So this is, from that perspective, market, first of all, wants this information. Second of all, puts high value of trust because into this typically because management is protected. Management is required to be truthful in these disclosures through the securities laws. Then we have consolidated balance sheets, consolidated cash flow statement, and reconciliation of GAAP to non-GAAP results. You can see that we have GAAP. It starts with the GAAP revenue, and then there's certain adjustments to arrive to non-GAAP measures. So, for example, the first non-GAAP measure that they have is revenue excluding foreign exchange effects. So they want to remove the effects of fluctuations in foreign exchange rates because, I guess the idea would be that, management is not responsible. It's something that they don't control, and they want to desegregate for users to see. Whether or not this is entirely legitimate argument, economically speaking, it's a debatable thing, but they're allowed to do that. It's important that they start with a GAAP number, not with a non-GAAP number, because they don't want to. They want to emphasize the GAAP number, and they're required to emphasize the GAAP number. Companies have gotten into trouble for starting with non-GAAP number because it will catch the investor's attention at the expense of the GAAP number, and so on. So right now, I just encourage you to be aware of it. That there's this non-GAAP disclosure, and it's provided for the benefit of the investors, for the alleged benefit, I should say, under the belief that this is in fact something that's very relevant to the value of the company, because GAAP could also kind of the idea is that GAAP could distort the true economics of the firm. Now, as you work on your projects, I expect you to fully go through and analyze this quarterly press releases to recent conference calls, to understand as part of understanding of the background of the firm and what's going on and so on. You can also, and the nice part is that it also provides you with balance sheet, for example, in the Excel format, and the income statement in Excel format, and that's very handy for you guys, in particular, as you do analysis of ratios and trends and so on. So very much take advantage of that if it is available when you analyze your companies. You can also see there's a transcript. If you don't want to listen to the conference call, here's the transcript, and you can see that participants are the CFO, the VP of Investor Relations, Mark Zuckerberg, who's the CEO. He kind of gives his spiel on what happened in the company. It's a rather long one. And there's Sheryl Sandberg, who is the Chief Operating Officer, and so on. And then if you go down, you will CFO speaking, and then there are questions from analysts, and those are actually important. And I encourage you very much to read the transcripts, understand the questions, because analysts they're not meant to be a passive audience. They're there to really try to understand the position of the company, so they can properly report on it and kind of challenge management, ideally, on their understanding of the of what happened over the last quarter and what's going to happen later on. And there's also, apparently, that particular quarter, there was a follow-up call as well. So, and the interesting part is that they also write in the same spreadsheet, in the same website. It gives you the quarterly Form 10Q, of course, which is an example of mandatory required disclosure filed on EDGAR. They give it to you here in a PDF format and the doc format and so on. Obviously, this is something that that gets filed on EDGAR, and so if we go to SEC EDGAR, I can go straight here, company search. I will type in Facebook here. You can also type in their the ticker, and you want to type in file type, in this case 10Q or 10K. Here it is. This is the 10Q as it was filed on the EDGAR website. It's also you can see it says IXBRL. It's filed in the IXBRL format because they're required to. But as you can see, what's nice about it is it has all these different links that we've observed before. So if I click on them, it gives me all the background information and so on. But for your benefit, Facebook provides the queue on their website as well. Let's see what else is interesting here. Let's take another look at the press release. Let's see if they give guidance. Not every company. So it's interesting that Facebook chooses not to give guidance. Guidance would be the forecast of performance for next quarter or next year. And it's, some companies do it. Roughly a third of public companies historically have done it. It's not required, it's completely mandatory. But lately, well, for a long time now, providing guidance has been blamed for kind of short-term focus of the firm. So some high-profile companies, they choose not to provide it. And so I guess Facebook is one of them. But typically, that's where you will find it. If it is provided, it will be in the quarterly press release. I just want to double check. It's nowhere here. Doesn't look like it. All right, so that's Facebook earnings information page. Very informative. I wanted you to see it. I mean, for your company, as you write the project, I'm going to specifically assign companies that are larger, well-known companies. They should all have something like that. Also we can look at Alphabet, for example, for 2015 results. Alphabet, of course, is the parent company. Here's their press release for comparison. They give us financial highlights. They give us non-GAAP information and GAAP information. So, there's no required format how it has to look. The press release will, the structure will be approximately the same, will be similar across particularly larger companies, but it's voluntarily provided document. So companies could decide how they want to best structure their information. They also give us information on the headcount, capital expenditures, free cash flow, which is also a non-GAAP measure technically. They also give us information on clicks, cost per click, paid clicks on Google website, and so on. Let's see if Google provides guidance. They also do not give guidance. And they don't really give any information on forecasts as well. Okay. All right. So this is what you would find in a regular plain vanilla press release. Let's take a look at some interesting articles that have been published. And you don't need to read these articles. I'm posting them as just examples of how press might discuss earnings releases. So obviously, earnings releases are very important when the company exceeds or beats analyst estimates or expectations of earnings or forecasts of earnings. Typically, the stock price goes up. If they miss it, it goes down. Historically, it's not always necessarily the case, but on average, I think it's still true. Here's the Wall Street Journal article. Our upside earnings surprises have a downside. So companies that beat earning estimates are often punished by investors as quality of quarterly performance forward guidance held more sway. So the point of this article, and if you have a Wall Street Journal subscription, you should be able to read it. If you're interested in this particular article, University of Baltimore also gets Wall Street Journal feed through the Bogomolny library. But so I just want to highlight some interesting irregularities that this article pointed out. So this is end of 2018. 161 companies in S&P 500 have announced better than expected earnings, meaning their actual earnings exceeded analyst expectations or analyst forecasts for the quarter, have had their stock price pounded down anyway. According to John Butters, senior earnings analyst at FactSet. FactSet is a data aggregator that aggregates data. So why is it the case? Well, here, among them, advanced micro devices, which beat analyst average forecast by nearly 5%, which is actually quite a bit, but whose stock fell 29.6% in the days bracketing the announcement, meaning around it. And here, in this particular case, Alphabet, Amazon, and Apple also beat earnings expectations, only to have their shares fall. So why is it the case? So what's going on here? So here's what it says. Investors are saying, forget about whether you beat earnings expectations last quarter. What is your outlook for next quarter, next year? What's your guidance? That's all we care about now. So, I mentioned guidance too before, but which we didn't necessarily find in the press releases we looked at. But in this particular case, what the article is basically saying is that investors don't care what you did done last quarter. What do you expect to do? And so in this, what it means is that earnings guidance or earnings expectations of companies essentially is driving the stock price, not the historical performance. So that's and that's one reason, by the way, why some companies may choose not to provide guidance anymore, is because they don't want to give this information to investors to kind of to do, essentially they wanted to divert investor attention from them. They want them to maybe historically focus on historical performance. That would be one possible explanation. And there's a bunch of others that you see in the literature. So that's interesting, right? So it's not about, the point of this article is it's not all about history, it's about the expectations of the future and the degree to which history kind of drives the expectations. Here's another interesting one. Overall grand expectations for Starbucks. Coffee chain Starbucks surprised investors with better than expected growth in earnings, but the time to pounce on the stock has probably passed. So it's kind of a positive article, again, also from the end of 2018. Fiscal fourth quarter earnings per share came in at 62 cents, 2 cents better than expected. Comparable store sales rose by a respectable 3% from a year earlier. So here's interesting. So, they exceeded analyst estimates again, but also the other item of the report on the same comparable store sales, or same store sales is the other term that means the same thing. And that's a non-GAAP type of or non-financial measure, really, non-audited again, that is very much relevant and is referred to for retailers, right? Because you want to make sure that you compare apples to apples. For retailers, if you added stores during the year, of course it will drive your sales up. But so you want to see whether the sales growth was driven by the stores that were there last year and this year. So it talks about kind of like Starbucks giving us the kind of the graph of its price to earnings ratio. You see it's was a lot higher, has been drifting downwards over 2018, and because of this last positive surprise, has gone up a little bit. So the market kind of assigns higher value because of that. So the results were encouraging enough to send shares 9%, up 9%, and after hours trading on Thursday afternoon. So the investors, obviously in this case, were very excited about the results at Starbucks and reported. All right, so there's the one that's very, very recent, which is about Amazon. Amazon's streak of record profits for ends. So you may be aware of the fact that for a long time now, Amazon has reported very high profit growth, and this wasn't the case this last quarter. So you can see this is July 2015, 2019, which is basically about 10 days ago from at the time I'm recording this video. So it says, and here you can see it went down 0.32%, about a third of a percentage point. A record quarterly profit streak has ended as the online retailer faced higher shipping costs, slowing growth from cloud computing business, and steeper loss limit on its overseas retail business. A company's second quarter profit rose 3.6% from a year ago to 2.63 billion after more than doubling last quarter. But it missed analyst consensus estimate. Amazon had posted its better than ever profit the previous 4 quarters. So, when you have this consistent increases in profits compared to typically a year before, from quarter to quarter, that in the jargon term is a positive earnings streak, right? That's what it talks about here. Amazon's streak of record profits, right? So they had 4 quarters of profits consistently exceeding profits from a year before compared to the same quarter. And then the article discusses that Amazon's profitability was hit in particular by surging shipping costs. So you will love one-day shipping, but it's eating in their bottom line. And you can see the kind of the graph of net income going down. Obviously, the market loves it when the company exceeds its prior year comparable profits for a quarter for a long period of time. But it's a party that typically never goes on forever, right? It's great when it happens, but we will learn as we learn about mean reversion, economic Darwinism, and stuff like that, cannot go on forever. The company that I would say, in my experience, has experienced positive earnings streaks for longest period of time is Apple, and that, of course, is driven primarily by popularity or extreme popularity for a long period of time of iPhone. But today iPhones, incidentally, the revenue from iPhones for Apple has gone down, and Apple is trying to reinvent itself by actually selling services primarily, because obviously the smartphone market is getting saturated. Its competitors are eating away from it. But these are kinds of things that people look at as they analyze companies. Essentially, how long, if the company is selling a high demand product, as would be the case in iPhone, the key element is how long could this last, and the longer it lasts, the more valuable is the firm, the higher is the stock price of the company, and that was the case for Apple for a long time. Not today, as would be expected. Actually, I think it exceeded anybody's expectations. That great party is over, and Apple is trying to reinvent itself by selling other types of services. All right, so this is what I wanted to kind of talk about in terms of earnings announcements. Now let's take a look at some analyst reports. Here's an example of a rather old analyst report on Microsoft. This is from 2007. You will see an analyst report typically will have, and this is from Piper Jaffray. Piper Jaffray is an investment bank based analyst by Michael Olson, here, senior research analyst. So here it gives you kind of the statistics that analysts report on. The rating, which is the recommendation, their expectation of how the company would perform. And this is back in 2007. They expected to outperform. The other term you would, more commonly used would be a strong buy. They think this is a company that whose price will grow. They think that the target price, which is the price where it should be, is about $38, which is today, as you may notice, $31. So they think that Microsoft, in fact, is undervalued. So therefore, they are given the outperform strong buy recommendation. Here, they're given their forecasts of 2007, 2008 revenues. and they're given their forecast of 2007, 2008 EPS. So, or earnings, really, earnings per share. So, from here we learn sort of the basic statistical elements of analyst report is would be the recommendation, which could be strong buy, hold, or sell. Sells don't happen very often. Hold and sell are kind of more negative recommendations. This analyst uses outperform, perform, and underperform, I guess, which would be equivalent terms. You will see price target. Price targets are not provided by all analysts, but that is essentially their estimate of what the fundamental value of the stock should be, long-term kind of value, what should be. They will give earnings forecast. All analyst reports will give earnings forecasts, and a majority will give revenue forecast as well. Now, what we learned from research is that that's not the most important by far element of the report. It's the one that people tend to focus on the most, because when we talk about analyst expectations or beating or missing analyst expectations, they talk about this EPS numbers, right? The EPS forecast. So when we talk about Microsoft exceeded or missed expectations, they talk about this EPS forecast for a particular year or quarter. But what research has shown is that the value of the analyst reports, and this is what's called sell-side analyst reports, which this is the report that's produced for the benefit of outside mutual funds, outside investors, their clients, is in fact in this analysis that they give, they discuss the performance of the firm, kind of like how they perceive the results, where the growth will come from, and so on. And that's essentially what you will be producing in this class in a very different format, in the format of a term paper. But essentially, you need to think about what you're doing in this class is a production of an analyst report for the benefit of outside investors for the company you're looking at. Here's an example of a similar report for Walmart. Also, we can see very similar structure. Rating in this case is neutral, so he says hold it, right? Doesn't think that there's going to be a lot of growth in the stock price. Here's the price right now is 54.39. Target price is gives a range between 53 and 58. So he's like, either it's going to go down slightly or will grow by a little bit. So he's not particularly bullish on the stock at all. The group of analysts, whoever, then they will give us somewhere within the report. So they will give us a forecast of the EPS and so on. So very similar, but most important again is the discussion that that's where the value of the report comes from. That's what their customers, meaning outside investors, mutual funds, really value. They don't really care as much about the numbers, the forecast. Their value comes from the analysis, and that's what you need to be doing in your reports. That's what I will be looking for as well. So here's some interesting articles. Again, here's how 2 analysts became SEC whistleblowers. Analysts also, they're kind of watchdogs in a way, right? So there have been cases where analysts, by virtue of analyzing numbers, they notice some strange patterns, and they catch fraud, that they catch accounting fraud. So in this case, it's Orthofix International, and they called up SEC about it. The Texas-based medical device maker kept hitting ambitious earnings targets. Many analysts had a buy recommendations on the stock again, so they're consistently exceeding expectations. Research showed that kind of very consistent kind of like hitting expectations is associated with higher fraud risk, because it at times comes not from true positive performance, but from actually fudging the numbers. So the analysts thought something was off. Earnings report showed it was taking longer than usual for the company to get paid by wholesale customers. Invoices were piling up. Executives struggled to offer convincing explanation, right? So they're asking them in conference calls all these questions like, what's going on? And they don't hear clear, convincing explanation. So when investors during conference calls start kind of muddying the waters, that's what research shows, there is a high risk of fraud. That's why it's very important to listen into conference calls, and a lot of information comes from that. How investors respond, how they answer questions. Are they really clear in their explanations? Do they brush people off? If they do, that's all kind of a bad signal. They really have something to hide typically when that happens. So anyway, they've done a bunch of analysis, and he talked to a friend of his, a fellow analyst, and essentially then agreed that something fishy was going on. Reported the company to the SEC, and now both men stand to win as much as 2.5 million after Orthofix reached 8.25 million settlement in January with the SEC. So that shows that financial analysis, when if people really do their job, could be very valuable in identifying companies that are dishonest. And in the next module we'll talk about Muddy Waters LLC, which actually was the company that kind of specialized exactly in that, by using financial analysis and identifying firms that are essentially lying and shorting their stocks. Taking private jets. So this is an interesting one. So that starts with the fact that today analysts don't just, their value of information, most valuable information doesn't come in anymore from the financial reports, comes in from all other things that they can observe about the company. And now with the big data revolution, you can actually get so much more valuable information from kind of resources you couldn't think of before. So here's an example. Hedge funds are tracking private jets to find the next mega deal. So in fact, what the article talks about is that hedge fund and the analysts, they see where the executives of the companies they follow are flying to. And that would suggest that they're negotiating some M&A deals, and they're trying to predict, well, which company do they want to buy, or what stock deal they want to do. And they take positions in the stock market on the basis of those expectations, right? Nothing wrong with that. It's public information. They're trying to just infer that from the travel patterns, which are public, which is, 10 years ago, I didn't really hear of that. Another article that I want to share with you is an article by a fellow academic where that I've actually kind of interacted with recently. He develops models on subscription valuation of subscription-based businesses like Amazon, and he's a marketing professor, and so talks about how Wharton marketing students bid Wall Street analysts at their own game, right? So really understanding the value of the customers and information on customers. Dan McCarthy and Peter Fader are the two faculty members that do research in this area. Also gives you edge in really forecasting the value of the firm, right? So that goes back to our whole discussion about business analysis. And today, with kind of customer base getting to be very different than before in the economy, understanding the value of the customer, every single subscriber that Amazon has, or any other company has, what's their value? What does the subscriber base go? That really drives the value and kind of gives us a sense of what should give us better sense of what how well the company will do. So these are some of the interesting articles on the analysts and so on. Another potential source of information about the company is the SEC comment letters. So first, I want you to understand that when the company files their financial statements with the SEC, it files it, right? But then there's a certain period of time where the SEC staff could review them and ask questions and ask companies to amend the filing for any disclosures which they feel are inadequate. And at times it uncovers, valuable information. So I want you to take a look at the PwC, which is PricewaterhouseCoopers, as a nice the comment letter process, how it works. Finally, I have a set of articles here that you may want to take a look at about the value of trust in the financial statement process. Everything that we get, from companies, in particular in the voluntary disclosure space, is based on our trust in those numbers, right? If the companies violate this trust, as was, for example, with, some bad events that companies do, like, for example, with the recent Boeing crashes and stuff like that, where investors no longer believe the management, then it will have real valuation implications. So that's what's interesting about this article here. Just discusses that trust by itself, in other words, the corporate reputation for honesty, is really the key to our reliance on the voluntary disclosure information. Anyway, so that's my short, well, no longer short, it's over 40 minutes, overview of what you will find here. The most important elements that you need to take away from this lecture video is the understanding of voluntarily provided corporate earnings information, the role of analysts, and information that analysts provide in their reports. I strongly encourage you to review some of the examples of the analyst reports they give you, and try to emulate the kind of the style of or the analysis style of what you're going to do in your papers. In your papers and your term projects, I'm not really looking for. I don't really care about how well you're adept in Excel spreadsheets. That's obviously I'll look for that, right? It's a basic requirement, but it's the depth of the discussion, the ability to tie the numbers that you have, to tie the analysis of ratios and forecasts and everything else you learned about the business to how you believe the business will do. That's what I will grade you on, right? And that's where I want you to be creative. I want you to be specific. It's not about whether I agree or disagree with you. We can disagree. But I want you to really show me that you thought about this. If you are just going to give me a bunch of generalities and non-specific statements, that's not really valuable. It doesn't show the level of understanding that I expect you to have in the end of this course, and that your grade could suffer as a result. So, that's very important. So as you prepare for your projects, please, go to the company's earnings information page, listen to the conference calls, read the press releases, read the analyst reports if you can find them. Sometimes they're available for free. Typically, you need a subscription, but you will find some, or you will find articles about analyst reports. Try to gather all of that and really synthesize it in your head. Try to connect it to your understanding of the business. Don't take it at face value. In the end of the day, it must be your thoughts, right? Discuss it, think of it critically. So that's what I'm looking for actually in your term project. And I wanted to state that upfront right in the beginning so that you understand what the goal of the class is and what I'm going to be looking for when I grade it. Thanks a lot and have a wonderful day.